versus existing customers. So a lot of banks have traditionally had, introductory offers on credit cards of 0% or whatever. But RBS is saying we've stopped that. And that's good, that is a positive development, but they're trying to claim because they've done that, they've cleaned out their whole Aegean stable, which is obviously ludicrous. So in terms of major developments at RBS since this book came out on the 6th of June. One thing I forgot to say is McEwen is genuinely trying to simplify and shrink the bank. So, whereas Hestus wanted to maintain the global universal, or what we call it, the global business financial supermarket that was Goodwin's legacy, or at least in some sort of shape or form, Hester had a huge falling out with the UK government over that because he was determined to he wanted to do that. He wanted to keep a big investment bank. He wanted to remain a global player, albeit with some adjustments. The new guy, Ross McEwen, is much more willing to be basically told what to do by the government, by the Treasury, via this fig leaf, which is called UKFI, UK Financial Institute, UK Financial Investments, yeah, which I could talk about as well. But I've described them as a bunch of chinless, wonder, superannuated investment bankers who should not be acting, who should have no role in running a bank if they're seeking any type of reform, because these guys are superannuated investment bankers who've all left the likes of JP Morgan or Goldman Sachs or other investment banks. Their sole obsession is growing the profitability. They don't care how it's achieved. So the idea that they should be representing the UK public as the agency which controls our ownership stake in banks like RBS, to me, is farcical. Just in terms of developments since the book was published, on the 8th of August, you had the shock announcement. RBS was closing down its business support unit, Global Restructuring Group, the one that Lawrence Tomlinson had complained about. And I wrote this at the time. As RBS continues to deny wrongdoing in every single case where it has snuffed out a viable UK company, it gets the huff and acts as the two top guys who are widely seen as leading the serial massacre of British SMEs by shutting down what has been described as its corporate psychopath unit. It has been suggested that quite a lot of shredding will follow. The bank still has to contend with the FCA's S166 review and the ongoing Serious Fraud Office and Crown Office and Procurator Fiscal Service probes into this, which some regard as possibly the UK's largest ever banking scandal. A tsunami of litigation will follow. The point is, I don't have any faith in the ability of the FCA, which is the Financial Conduct Authority, or the Serious Fraud Office, or the equivalent in Scotland, which is the COP, to actually get a problem with this. They don't have any real interest. The problem is that because the government owns 81% stake in this bank, there's what I call moral hazard. It doesn't actually care, or it might care a little bit. It doesn't want to find things out, rather than kick them under the carpet. Because if it does find out the truth of what's actually going on inside this fund, which has been phased out conveniently, it would reduce the potential resale value of the shares. So I would say that the UK government is basically in an intolerable, we and the government and the bank are in an intolerable position because it's conflicted. On the one hand, if it was doing its job, it would want to prosecute criminals within a bank and root out criminal practices and fraud and criminal corruption and etc. inside a bank. But on the other hand, it actually owns an 81% stake in one of these banks. So what do? I've got an interesting letter from the private secretary to the Governor of the Bank of England. It's called Alex Brazier, and this was sent on the 1st of September 2014. It was addressed to Mrs. Turner from the SME Alliance, and it says, "Your letter also notes a concern that regulators have not acted to penalise relevant individuals in relation to your case, and the banks are somehow above the law and able to avoid prosecution. This is a view very much not shared by the Bank of England. As the Governor's recent letter to Lord Blackwell made clear, there is absolutely no doubt, by the way, Lord Blackwell is the chairman of Lloyds, made clear, there is absolutely no doubt that bankers who are guilty of misconduct should face the regulatory and or criminal consequences of their actions. No one is above the law. So that's vaguely reassuring. That's effective from Mark Carney, who works for his private secretary. But I don't know. I mean, this is one thing I wanted to just conclude with, which is to do with the regulatory changes that have happened since the banking crisis of 2008. There have been actually quite a lot. You know, there's new Basel capital ratios have come into place. There's a much more intense scrutiny of bank board members. You know, they don't just allow anyone to join the board, like Mr. Flowers, Reverend Flowers, or whoever it might be. There are a number of changes which have been listed in a speech by Sir John Cunliffe, the Deputy Governor of Financial Stability at the Bank of England, at Prudential Regulation Authority, which is part of the Bank of England. So he's listed all these changes, and they do seem vaguely impressive. But one of the things that he says is that as a proportion of profits attributable to shareholders, the top brass of banks are taking out a huge, far greater percentage. So this is a problem. And he gave the figures here. It went down from 60p in the pound. When was that? Since the crisis, the picture has changed dramatically. In the 10 years before the crisis, for the global banks, profits attributable to shareholders averaged 60% of the pay bill. For the big UK banks, profits were about 75% of the pay bill. Across the big UK banks in 2013, the fraction has fallen to just 2%, or 2 pence in the pound. So basically, well, one could call this looting. This is like huge paychecks being paid from not very profitable banks to executive management and even to non-executive directors. If you look at the rates of pay, even for a non-exec director since 2008, it's more than doubled. It's almost doubled in most banks. Despite the fact that profitability has been hugely squeezed, these guys have some kind of sense of entitlement that they deserve a pay package of, say, 3 million a year plus pension contributions, even though they are not actually restoring the bank to health, and even though they are, even though the bank, in RBS's case, is continuing to lose money and has lost the entire sum we put into it, which is 45.5 billion in losses since the crisis. So it's very odd that. And maybe that does suggest that despite Cunliffe's idea that actually, there's a lot of new regulations and changes in place, they're still at it. They're still getting away with quite a lot. Other things will squeeze banks in the future. The rise of online and mobile apps, they will be outpaced by technology firms like Alibaba, like PayPal, like Tencent, like M-Pesa in Kenya. These companies can do online person-to-person or person-to-merchant transfers for a fraction of what banks charge. The bank charges on those sorts of things are actually scandalous. So there is a belief that banks actually will be almost put out of business by the rise of these more tech-savvy firms who are perhaps more customer-focused, like the ones I mentioned. Also, you've got the rise of technology-savvy crowdfunding and peer-to-peer lending firms like Lending Club in the US, Funding Circle in the UK, Market Invoice, SOPA, RateSetter in the UK. So these will, if they don't put the banks out of business, they will at least make them less profitable, and therefore the sorts of pay levels that we're seeing from top bankers will become harder to sustain. So, I mean, I didn't quite how to conclude, but I was going to mention at some stage in my talk about a bank called Williams Deacon's Bank.
Oh, yes.
Yeah. Well, Williams Deacon's Bank merged with Manchester and Salford Bank in 1836. Williams-Deakins was founded in London in 1771, but at the time of that 1836 merger, it moved its headquarters to Manchester. And I think that's right. Then there was another merger with Glyn Mills to form a different bank. And then I think all of those banks were acquired by the Royal Bank of Scotland in 1930, because it was doing actually better than a lot of the English banks at that point, and was able to make acquisitions here in England.
It's called William and Glyn's.
Yeah, so it became known, in 1969-70, RBS merged Williams-Deakins with Glyn Mills and Co. Yeah, sorry, I got that wrong. They did it in 69-70, and that remained a brand that was used till 85, at which point 327 Williams and Glyn's branches were rebranded as Royal Bank of Scotland. But now this is repeating itself because Neelie Kroes, who's the EU Commissioner, ordered RBS to dispose of 327 branches in June 2009, much to the chagrin of Alistair Darling and of Stephen Esther. And so they are being sold off. 327, roughly, or it might be 318 actually, branches of RBS will be sold, or are in the process of being sold, and will become known as Williams and Glyn's, which will become known as what Vince Cable calls a challenger bank, which is what TSB supposedly has also become. So this is one of, I don't know, it's quite interesting, perhaps one of the more positive regulatory changes that has happened to the banking sector since the crisis. Is actually forced on the UK by Europe. It wasn't anything that the UK would have done without this very tough lady, Neelie Kroes, forcing them to do it in June 2009. So I'd like to mention that.